It's no secret now that the multifamily sector has held up well through COVID. It may be counterintuitive that even with high jobless rates and eviction moratoriums, but that's COVID. It's counterintuitive. Our Journals held a multifamily event last week with numerous lenders, agency representatives. I was there asking questions, as usual. Unsurprisingly, low rates are causing a refinance boom. Laura Simpson, director with HUD, what is the lowest rate you have seen this year?
We've seen as low as 2.05. That's as low as we have seen. I think that's on a refinance. We're holding steady at 2.45. Is I've seen 2.35. I mean, I don't know what Freddie is. I don't know kind of where other places are sitting, but that's what we're seeing.
We've also got Samantha Miller with Freddie Mac. Samantha, where are Freddie rates?
On the fixed rate side, I'd say low to mid threes all in. That's pretty consistent depending on leverage. On the floating rate side, we did transition from LIBOR to SOFR recently. August 1st, we started offering SOFR-based loans, and we'll have fully transitioned now. We're not quoting any more LIBOR loans, and December 31st is our last date to purchase LIBOR. So in terms of our ARM spreads, we're at, I'd say, 260 to 290 gross on the floating rate product. That has been really strong, a strong business for us, and we've done a good amount of our floating rate business this year.
Brett Olson, super broker with Grandbridge. Can you fill us in on Fannie rates as well?
Todd, I can jump in here a little bit from what we're seeing on the Fannie Mae side in terms of pricing. A lot of what we do is tier 2 business, or kind of their full leverage. Right now, seeing a lot of 75% loan to value, 125, 130 debt service coverage minimums. But that type of loan pricing today is probably around 315 all in rate.
Developers and owners have been the beneficiaries, but so are low-income renters. Lower interest rates have allowed affordable housing developers like Sherman Associates, one of the largest affordable housing developers in the nation, to make sense of new projects.
On our end, the biggest driver for moving some of these projects forward over the last 7 months has been the drop in interest rates, both immediate but also long-term projection on where interest rates will be 2 to 3 years down the road as we bring in long-term financing. The drop in interest rate on our construction financing has a nominal impact on moving a project forward, but that long-term interest rate certainly has a more substantial, as we're looking at agency takeouts with HUD or Fannie, to be able to underwrite a rate that's 75 to 100 points lower for the long term certainly is having a meaningful impact on the viability of these projects.
Chris, are you also taking advantage of these rates and refinancing?
So for the last 8 months of the roller coaster we've been on, one of our big focuses has been refinancing existing debt. And during that 8-month period, we've refinanced about half of our portfolio debt using a variety of tools. And as you noted, one of those tools has been HUD insured financing, where we may have a 8 or 9 or 10% prepayment penalty. And then what we're electing to do is roll a portion or all of that into the new rate. And we do cover some of it. And those refis are making sense right now. HUD, and these are deals that in certain cases we refinanced 5, 6, 7 years ago. So rates have come down that much. Again, we're back to where we were probably late 2012, if not a bit lower today. So HUD is low 2s plus MIP. And we're looking to refinance a few deals here over the next 6 months and roll prepays into the new rate to get them down into the 2s. And we're also working on a variety of other, we've also closed a variety of other refi transactions from Fannie Mae. We did a lower leverage Fannie Mae execution on an asset about 2 weeks ago, 60% LTV, and had that rate down well below 3 with 8 years of IO. And we've done a lot of deals with our banking relationships, and that's been a big thing for us, is just working with our existing relationships to refinance assets here and take out, in certain cases, construction financing and kind of mini perms that were higher cost, higher leverage. We've closed on several fixed rate deals and several swaps over the last 7 months, and a lot of those have been low to mid 3s on 7 to 10 year executions, but a lot of this is long-term. I mean, we're with HUD, that's 35 to 40 years. With Fannie, it's 10-year deals, and with these fixed rate swaps, it's 7 to 10. So we're locking in these low rates between really low twos to low threes for the next 7 to 10 years. And
there you have it. Multifamily finance is booming, in case you haven't figured that out. What a great event. Hey, you can log in to you don't even have to log in. You can go to our YouTube page where you found this show. You can see the full clips of this event, the whole thing. It's on there, as well as a whole bunch of other events, 100 plus, that we've been doing since April to keep you in the loop on things like multifamily interest rates.